RCI Hospitality, ticker symbol RICK, was my most rewarding investment from 2020 till 2023. I started buying shares at about $15 and saw it rise all the way to $100, all while buying more shares at each step along the way. What made it so insanely rewarding over this 3-year time period is a combination of two things. Firstly, its starting valuation was very low, allowing for significant multiple expansion in the following period. Secondly, the company went on an acquisition spree which significantly expanded its free cash flow. The market had rewarded this growth with a higher valuation multiple, which combined with the growth resulted in significant upside. I'm bringing this up today because I think that the next few years could resemble the 2020 to 2023 time period. Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and over the past years, RCI Hospitality, ticker symbol RICK, has been one of my largest holdings. This is the only publicly listed company that specializes in the ownership and acquisition of adult nightclubs, and we think that it has a very interesting business models that likely to earn alpha-rich returns to its shareholders over the long run. In today's video, I'm gonna give you an update on this position, but before I get into it, can you please do me a favor and click the like button, subscribe to your channel. That always helps me to keep producing this free content for you. Thank you so much. Let's get right into it. REIT has just gone through a 2-year-long bear market, just like most other listed real estate companies. The surge in interest rate hurt their market sentiment and caused their valuations to drop to historically low levels. But REIT dropped even more than the rest because it also faced some sector and company-specific headwinds. The reopening of the pandemic initially led to a boom in business for clubs as people were getting stimulus checks and wanted to go out and have fun. Moreover, international borders were still closed, leading to more domestic travels, especially to destinations like Miami and New York City, where many of REIT's clubs are located. But some of this business wasn't sustainable in the post-COVID normalization period, and this caused REIT's same property performance to suffer. This also prevented it from acquiring new clubs because sellers were basing their valuations on these boom years which were not sustainable. And the high interest rates of course didn't help either. All in all, this caused the share price of REIT to drop from nearly $100 per share to just $50 today, pricing it at a low multiple of just around 9 times its free cash flow. However, we think that REIT is now about to turn the corner. Its same property performance has now stabilized with several consecutive quarters of positive growth for its clubs. This is a clear sign that the post-COVID normalization period is now coming to an end, debunking some of the bears who claimed that clubs were now in a permanent decline. The pandemic simply led to some bumpiness with an initial surge in business followed by a normalization period. This happened for a lot of different industries as well. But even more importantly, REIT has now finally announced its first club acquisition since October of 2022. Just recently it announced that it would acquire Flight Club, which is one of the leading clubs in the Detroit market, just 5 miles from the airport. And the economics of this acquisition are the perfect example why we like REIT so much. When you think of your average REIT, they would typically buy properties at a 6 to 7% cap rate, which would then result in a 100 to 200 basis point spread over the cost of capital. You raise capital at the cost of, let's say, 5%, you reinvest it at 6 to 7%, and you pocket the spread, rinse and repeat. The potential for value add is also relatively limited in most cases for REITs, and the same property growth is mostly a function of the local market, which varies depending on the supply and demand dynamics. Now compare that to REIT. It's acquiring this club for $11 million and it's currently generating about $2 million of annual cash flow, which implies that it's getting an 18% cap rate. The initial yield is so much higher because there is a relative lack of buyers for these clubs. There are plenty of investors who are willing to buy an apartment community as an example, but there are very few who are willing to buy a club because of the social stigma and the managerial difficulties. And this relative lack of investor demand puts REIT in a strong position to acquire clubs at relatively low valuations and high initial yields. And gets a lot better. Firstly, we should note here that the $2 million of cash flow is backward looking. This is a property sector with significant value add potential, and historically REIT has commonly been able to increase the cash flow of its new club acquisitions by about 20% by simply reducing costs thanks to its scale and boosting revenue through superior marketing, better pricing strategy and its systems know-how. Therefore, the forward cash flow yield could actually be quite a bit higher at above 20% if you just increase the cash flow a bit with some value add. And now let's also break down the purchase price of $11 million. REIT is paying $6 million in cash and it's getting a $5 million seller note with an 8% interest rate. So it's really just paying $6 million of its own cash to acquire the club, and the rest is a seller note that's backed by the club itself. The annual interest expense should be about $400,000 on this seller note, and so taking this into account and the fact that they're only investing $6 million of their own cash into it, we estimate that the return on equity on this specific deal should be nearly 30%. And again, this is why we like REIT so much. No other property type offers comparable returns. The returns are only so high because the social stigma and the managerial difficulties are keeping most potential buyers away from this space. Other property sectors are far more competitive, and naturally competition is going to lower your returns. REIT is today the only buyer of scale with access to public capital markets, and it makes it the buyer of choice for most of these clubs. It gives it a durable competitive advantage to keep consolidating this fragmented space, earning exceptional spreads over its cost of capital and resulting in alpha-rich returns for its shareholders. Earlier we said that the average REIT is happy to get 100 to 200 basis point spread on their new investments, while REIT is getting about 10 times more than that. Hopefully this deal will now get the ball rolling and reset more realistic expectations for club sellers and allow REIT to go on another acquisition spree in the coming years. If it does, then 2025 to 2028 could closely resemble 2020 to 2023, leading to significant returns for its shareholders as cash flow expands and its multiple recovers. As a reminder, REIT recently set the goal to roughly double its free cash flow per share over the next 5 years, and we think that this is quite achievable. So for these reasons, REIT still remains one of my largest holdings today, even despite the crash that it went through in recent years. REIT's business has earned significant alpha to its shareholders ever since it changed its capital allocation strategy in 2016. However, the one downside of holding REIT is that it can be highly volatile and it will at times go through extended periods of underperformance, testing the patience of its shareholders. I'll put a chart on the screen and you'll see this volatility here. It's been very significant, but over a long time period it has done far better than the S&P 500, but you need to be patient and long-term oriented. The pandemic, of course, only made this volatility worse, driving a boom in its business, which was then followed by a normalization period. But we think that this normalization period is now gradually coming to an end, and REIT is likely to return to another acquisition spree in the coming years, which could lead to significant returns for its shareholders. Not too long ago, we had the opportunity to interview the CEO of the company, Eric Langan, and we posted our exclusive interview at High Yield Landlord, which is my REIT newsletter. For this specific interview, we've temporarily removed the paywall, so if you want to read it, you can do so completely for free. It will be the first link in the description of this video. Make sure to also sign up for the free newsletter as we post one free article each week on one of our top picks. This is some of our best research that you will never see on YouTube, so don't miss out on it. Finally, if you thought that this update was valuable, please click the like button and subscribe to the channel. That always helped me a lot. Also, let me in the comment section below what other company I should cover next, what company should I provide you an update on, and otherwise, thank you very much again for your interest and see you at my next one. Bye bye.